Do you find this is relatively common? People in Sydney are obviously prices have grown, especially houses, maybe units aren't so extreme, but is it becoming more common that people are like, we could maybe do it given enough time, but it's just to the point where it's not really worth the headache, the effort, the stress. So maybe we should just save and then move elsewhere for kind of an easier life or an easier financial situation, because it's just going to be too stressful staying in Sydney or too much of a burden.
The Aussie Fire podcast is a collaboration between Strong Money Australia and Pearler, Australia's favourite boring long-term investing platform. Join our hosts, Dave from Strong Money Australia and Hayden from Pearler, as they discuss all things financial independence. At Aussie Fire, we're big fans of sharing experiences and talking about money. However, please note that any advice is general and does not consider your financial situation, needs, or objectives. Consider whether it's appropriate for you and, if in doubt, speak to a licensed financial advisor.
Hey guys, welcome back to the show. In today's episode, we're going to be diving into two financial independence case studies, and they're going to be from listeners who are at very different stages of their journeys. So one of them is going to be considering early retirement after stepping away from full-time work, and we'll get into that and the details surrounding that. And the other case study is from a couple in their 30s who are juggling family life and some home ownership goals as well. So I really enjoy doing these stories and these case studies, as you might have known, and so we enjoy getting them from you as well. So if you've got any that you would like us to go through, I actually counted this the other day, Hayden. We've got like 40 something. It's probably close to 50 now, actually, sitting there lined up. So
amazing.
It's probably just going to get bigger. I don't know, but we'll see how we go. We'll try and get through as many as we can. But yeah, these case studies essentially give us a chance to kind of peel back the onion a little bit and explore how fire works in real life with different situations and sometimes complex scenarios where there's not necessarily a right answer, a bit like with investing, but there's just like a series of trade-offs and you kind of got to figure out what's going to suit your situation best. And so we'll give our 2 cents on what we might do in similar situations for these particular case studies. And then to finish things off, we've also got a question about self-managed super funds and when they make sense. And correct me if I'm wrong, mate, but I don't think we've actually spoken about self-managed super funds before, so that's a brand new topic for us.
Sounds good. Looking forward to it. So I think, Dave, let's dive straight into it. Let's talk about the first case study. It's essentially the question, can I retire now? I'll read out the question from one of our listeners. I'm hoping for some perspective. I've recently decided to step away from my long-term employment and accept a voluntary redundancy. I'm 45, my wife is 46, and we have 2 kids aged 12 and 8. My plan was to take 6 months off, but I was wondering whether our current situation would support an earlier retirement. Our priority is to set ourselves up to support our kids while living comfortably on approximately $80,000 to $90,000 per year of income. Our current financial position appears good, but I'm not sure how long it would last and the best way to manage it. In terms of our financial situation, we own our own home, we have an investment property, mortgage, principal and interest, share portfolio of $525,000, a combined super of $500,000, and a savings of $600,000. It would be great to get some perspective on whether I can safely retire and take an approach of working ad hoc where required. That's the end of the question. It's a really interesting one. If I could just recap that, Dave, for myself. So they essentially own their own home, which we're going to assume they do outright, because that's how they've mentioned it. And they've got essentially this portfolio of assets of about $1.6 million. Some in super, some outside of super, some in a bank account, obviously. And they've got another investment property. And they're looking to get $80,000 to $90,000 a year. That's pretty interesting. I mean, I think firstly, I'd probably make a point to say that's a great position to be in. I always like to point this out, but yeah, that's a wonderful position, and it's always one of those, like, it's just shades of good in those kinds of scenarios.
Yeah, 100% agree with that. It's definitely an awesome position. I'm hoping, like you said, that the way they phrased it, we own our own home. I'm hoping that means it's paid off, and I'm going to assume that it is. But sometimes when people frame it like this and they have because they've got a huge savings account, sometimes that savings account will actually be an offset account attached to their home loan. And so they'll mentally think, well, my house is paid off because my offset is the same as the debt. And so in their mind, it's paid off, but that savings account could actually be an offset account. So I'm not sure if that's in addition.
Sure. No, it's a great point too, because most people aren't going to have savings of $600,000 sitting around that isn't an offset account, even just because of the fact that, government guarantees are at $250,000. It's actually, banks make it very difficult for you to easily have, 600,000 sitting around sometimes.
I mean, that's not easy to do anyway, let alone having to park it in different places. But so let's just go, we can probably talk about both situations, but let's just assume for now that savings account is actually separate to their mortgage and their home is actually paid off. So the tricky part is they're, what are they, mid-40s. So you've got about 15 years until they can access super. So part of that portfolio, which is 500 in super, is not accessible and won't be for quite a while. So the share portfolio itself would produce maybe 20 grand a year in dividends, something like that. And then they've got this bulky savings account and an investment property. And I'm going to actually assume that the investment property is costing them money. They didn't say how much equity is in the property, which would have been good to know. But the mortgage is principal and interest, and there's obviously costs associated. I'm going to assume it's probably costing them some money each month. So, I mean, at first glance, I would say they could easily semi-retire. But as for fully retire, I'm not so convinced about that. I'm not sure if you see it differently before we dive into some of the details there, mate.
I would say they're either halfway there or close, depending on some of those assumptions. And I think it's fair to say that if they've got savings of $600,000, that it's probably in an offset, and therefore they're probably halfway there. But if that is actual $600,000 of savings, then I would say they're close. I know you're going to run into the numbers a little bit more, but just for our listeners and how I think about it, when they talk about having, they wanted $80,000 to $90,000 a year income, the kind of reasonable ballpark to put that in is that, this particular couple is looking for a $2 million portfolio, roughly. And so then you can kind of make sense of it where they say, I've got $500,000 in shares, $500,000 in super. If that's all they kind of have, then that's $1 million. That's halfway to $2 million. They're halfway there. That's kind of how you get to those comments I was making. And it's actually really, just sorry to keep rambling, Dave, but it's actually a really comforting thing, because I think a lot of Australians will sit around being like, oh, I can't even imagine having passive income of $80,000 a year. But if you're just listening to this podcast and you remember that figure I gave you of $2 million, it's like, that is a lot of money, to be very clear. But that's a target, at least, very clear, obvious kind of target. But I mean, do you think I'm on the money, no pun intended, with some of those figures, Dave? Or do you think there's a lot more nuance that needs to get unpacked there?
No, I think pretty much if they do have a spending target of $80,000 per year, they are going to need something like $2 million, right? That's fairly accurate, and I think most people would agree with that. The tricky part is then, making it from where they are now to their super access age. And if we are to assume that this savings account or offset account is separate and that is investable money that they don't need, essentially it's not offsetting their primary place of residence, then they could invest that, which would give them over $1 million in shares, I think 1.1 or so. Then the income from shares is starting to look like 45 grand, closer to 50 grand. So they're starting to get close to offsetting their 80 grand of expenses that they're hoping to live on in a comfortable sort of retirement scenario. So then it starts getting very, very close and essentially extremely cushy if they're wanting to semi-retire, because that's only 30 grand that you need to make between two people, which is actually going to be extremely easy to do. If they're even just curious about any sort of part-time work, that's not going to be difficult at all to do. But the key point here is the investment property. I'd love to know how much equity's in there, because there could be a few more 100 grand sitting in there that they could then cash out and add that to the portfolio too, which is going to help provide maybe another 10 or 15 grand, get them even closer again. But one thing they did mention that is also a little bit of a question mark is they wanted to support their kids while also comfortably living on 80 to 90 grand. So I'm not sure what that means. Do they mean financially support? It's not clear if that means they want to also set aside money for kids, or they mean support kids as in spend time with them and educate them and things like that. So I'm not sure what that means. Obviously, if they want to put aside money for their kids as well for the future, that's going to essentially take longer, and they're going to need to have some money set aside for that, whether it's in the next 10 or 20 years. So that's definitely something to consider. The more things you want to build into your plans, the longer it's going to take, whether it's higher expenses or if it's setting money aside for different things. So that's definitely something to consider as well. And obviously the less you would like to work, the more you're going to need, or the more flexible you are around work, the less you can do it on. Hopefully that makes sense.
Yeah, for sure. I was wondering, Dave, one thing on my mind with this, which, for similar people who are maybe in their mid-40s, it's also a worthwhile time to really consider how that money is split up between shares and super. Because, 15 years out from actual super access, it might still feel like a long way, but, we all know life moves pretty quickly too. So that'd just be a bit of a side note I'd point out around you kind of have to do a little bit of planning there. And we've talked about this in a previous episode, but let's say you start with your $2 million that you want. You obviously think, okay, I've got 500,000 in super. I'll put the other $1.5 million outside of super. And naturally, that's beneficial because you have a lot more control over your money, though you're also going to pay more tax on more dollars over the long term. And if you start funneling tons of money into super now, you'll pay less tax over the long term, but then also you will naturally have less access to funds and various things. And I'm not really pointing out an answer there, but it's like getting that kind of ratio right is definitely something that's worth thinking about at this stage as you're trying to prepare your finances.
Well, it's tricky, right? Because then people will be like, well, what's the correct ratio? But there really isn't one, because it depends on, you'd have to do a whole bunch of modeling and try and guess what would happen depending on how much you're depleting your outside super portfolio. And then it's not always going to be beneficial tax-wise, because if you're living on $1 to $2 million of shares outside super and you don't really work, your tax rate's actually going to be lower than the super tax rate, especially if it's split between a couple. So you definitely don't want to just assume that living off investments outside super is going to be worse.
Correct, yeah. I'd say it'd be similar to the super tax rate for sure, for those kinds of sums, I imagine. But yeah, to the point is the benefit of super, the benefit of that gets greatly diminished based on your circumstances. And like another good example is that, if you do want to have a $1.5 million share portfolio that you've early retired on, then it is obviously beneficial if you can to break that up into two portfolios, one for you and one for your partner, right? Because then your incomes are getting assessed differently. And Dave kind of mentioned that. Now, again, that's not to say that that's what you should do, but these are kind of considerations as like, who holds the funds, the other considerations like what ratio is there, and it's all very kind of theoretical. And yeah, to Dave's point, it's a little bit of modeling. It's just something that like a savvy person can kind of do themselves. It's something that a less savvy person might end up paying someone for advice on or to do some modeling for them. Given the kind of sums of money that we're dealing with, it's always worth a thought. Generally, the good news is that there's caps on what you can easily put into super anyway. So like, it's not one of those things where you're going to be sitting around being like, should we put $1 million into super? It's usually going to be more, reasonable than that, but just things worth considering too.
Yeah, you are restricted obviously in what you can put in and in a certain amount of time and things like that. So yeah, lots to consider there. But just, I suppose overall, there's a few options in this particular scenario. So I think we would probably both lean towards funneling more of that cash into shares just so that it's going to create a more livable portfolio to then allow less work. And then obviously that quite easily leans into a scenario where you can then work part-time for the foreseeable future. Definitely don't need to stay in full-time work at this point. I definitely wouldn't be considering that. If it also depends essentially if they want to keep the investment property. I know some people are hesitant to just have shares and not have an investment property, so they might want to consider holding onto that as well if they want to, and then that's going to end up meaning essentially they'll have more money tied up in the property, and that will give them less available cash to invest in shares, and it may even increase the amount they need because there might be some ongoing costs associated with holding that property over time. But just on their super, it's 500 grand now, but if we roll that forward to say 15 years time when they'll be roughly 60 and hit the super access age, if they were to get like a 5% return after inflation and after fees and whatever, that's going to be worth $1 million in today's terms. So that's going to actually be a fairly sizable pot. So that's like going to provide them an extra 40 grand in today's dollars. if we roll that forward into the future. So it's always more than people think it's going to be when you roll it forward. And that also assumes nothing's been added over that time, like nothing from part-time work or whatever.
For sure, that makes a lot of sense. And I think it's important for anyone listening to look at those sums with a lower return rate like Dave did of 5%, because it's very easy to go, 8% growth every year. But looking at things in today's dollars is so useful, because otherwise especially when you look further in the future, like if I say to you, in 40 years, that 500 grand is going to be $4 million or something, you think, oh, that's nice, but I don't know what the future holds. Whereas if you kind of say, okay, well, in 40 years, that 500 grand is going to be $2 million in today's terms, you can picture exactly what $2 million can get you in terms of value. And I agree with you about the investment property, Dave. I'd say for me, and this is, disclaimer, someone who doesn't own an investment property and hasn't, the biggest kind of things that would weigh up on my mind are like, are you holding that investment property for your child to live in one day? Is that a big part of your strategy? Is it a promising, appreciating asset or not? Like, is it some kind of, random apartment in a part of a city where there's like 1,000 other apartments like that? Or is this like a house you bought in a growing area that has better prospects? Just how much are you losing on it? Because I could see scenarios where you might want to keep that as just an interesting way to diversify, or you might not want to keep that at all because it's just kind of a headache and the mathematics doesn't work out. But there'd definitely be scenarios where both of those, either of those make sense depending on the circumstances.
Yeah, I'd say just to round that off, I'd say another option is that if they did or were open to going back to work full time, I'm not sure if it's one or both spouses work in this scenario, but it doesn't really matter. If they were open to doing that, I think if they just worked another 3 or 4 years, they'd be in an excellent position to probably fully retire at that point with no hesitation. So that's my best guess at this scenario.
So I think in summary with that one, Dave, really interesting position. I think congrats to the listener for getting yourselves to a point where, you've got young kids and you can spend a bit more time with them and feel a little bit of the financial pressure off your plate and lots of different things you could do. Hopefully we've given some kind of different scenarios depending on the different kind of assumptions we've made there. But we'd love to hear how it goes in a couple of years. I think we're going to move on to the second case study, Dave. We've labeled this one Family Freedom and the Next Step. This is the question from the listener. My partner and I, in our early 30s, live in Sydney and have been tracking our net wealth for a few years. We just passed $600,000, made up of $265,000 in super, $225,000 in cash, and $110,000 in ETFs. Our household income is $250,000 and is expected to increase to $270,000 in the next 2 years. We recently welcomed our daughter into the world, and she's been a big motivator for us to save and invest. Our goal is to move regionally in 3 to 4 years, buy a house for around $750,000, work less, and spend more time with her. We've reached our $200,000 house deposit goal, but we're unsure whether we should keep growing the deposit to account for rising house prices or invest more in shares. What would you do in our shoes?
This is a super interesting situation, I think, because when people start saving for a house deposit, they kind of have a fixed dollar amount in mind. And in this situation, they've got the fixed dollar amount, but they're also not moving for a while. Or they're not buying for a while, so they're thinking maybe we'll need more because we don't actually know what the price of the property is going to be in 3 to 4 years' time. So then naturally they're thinking, well, maybe we need more than this, or should we invest in the meantime? Or, there's obviously multiple ways that they could approach it. So I'm actually really curious to see what you would do in this scenario, mate. But it kind of boils down to, should we focus on building a bigger deposit, or should we invest the money and just stick with this deposit and hope that it's enough? And I guess maybe we can sell some shares later if we need to, something like that. But yeah, I'd be very interested to hear your answer, and then I'll go after that, mate.
Firstly, love to hear from you. Thank you, because I'm in my early 30s and I grew up in regional Australia, so you kind of I can relate to the frustrations of Sydney and thinking maybe I should leave this place so that I can live a comfortable life.
Do you find this is relatively common? People in Sydney are obviously, prices have grown, especially houses, maybe units aren't so extreme. But is it becoming more common that people are like, it's going to be, we could maybe do it given enough time, but it's just to the point where it's not really worth the headache, the effort, the stress. So maybe we should just save and then move elsewhere for kind of an easier life or an easier financial situation, because it's just going to be too stressful staying in Sydney or too much of a burden.
That's a great question. As a quick tangent, firstly, for the people I know who are on the lower end of income and wealth, they usually don't consider it because they usually require a lot more support from their community, with like raising kids. So the idea of just moving to another city is kind of absurd for them because they rely on parents or grandparents a lot to kind of keep it all together. For my wealthier friends who, have great, high income, 6-figure jobs, if they grew up in Sydney, most of them would never consider leaving. And it's a very like, out of Sydney, there's nothing there kind of vibe. I joke with some of them. I'll be like, I'd love to move to Adelaide. And they're like, yeah. I'm like, it's not that bad. I've been to Adelaide. I think it's okay. So it's actually not very common. I'd say where it is very common, though, is people like myself who've moved to a larger city or have just made a big transition in their life because I think they're just kind of like more comfortable. That's kind of the short answer across it. So different kinds of people. But yeah, it does happen sometimes. And I'm not saying these people didn't grow up in Sydney, but I think more people should consider it because 80% of our lives in midlife we spend at home or at work nearby our home anyway. So like, why would you want to... sorry to keep this tangent going, but I was talking to someone literally yesterday about this, Dave. I said, let's say you have two options. It's either a $3 million house in Sydney or a $1 million house in... I don't want to say Adelaide because I haven't looked at house prices there, but let's just say out of Sydney, for argument's sake. It's like a $2 million price difference if you just invest that, as we've just talked about in the previous question, is $1,500 a week of income forever. So it's so hard when you look at the economics and be like, do I like Sydney that much that I will give up $1,500 a week of like permanent income if I had, say, a lump sum of money? And it's such an interesting question. So I love this question from the listener just because it kind of paints how people are using price differences between cities and regions to get through it. But back to your original question on the question, Dave, what do I think of this situation? I think probably the most notable thing for me is like you talk about you want to move regionally in 3 to 4 years and you kind of have this $225,000 in cash. That feels like a lot of cash to sit around to wait 3 or 4 years. Now, I don't want to kind of say invest it because a lot of investments that people like Dave and I talk about, like, the Vanguard index funds will typically have time horizons of 7+ years, Now, that's not to say that it has to be 7 years. It's more like, over 7 years, there's a pretty good track record of them doing better than cash. Whereas, less than that, there's maybe like a 90% chance it does better than cash or something like that, right? So don't take those figures exactly. So my first thought is like, you should probably consider looking at more ETFs that maybe are just a little less risky than some other ETFs and investing that money if you're still years away from buying the house. And that kind of then also simplifies your question a bit because now you just can kind of have your like longer time horizon ETFs and your slightly shorter time horizon ETFs. And you can just invest more and more of your cash, and that'll do a bunch of things. It'll take pressure off finding the exact amount to save for a house deposit because you're also investing. It also takes the pressure off, and I can talk to this as like someone who only recently bought an apartment, that feeling of like the housing market getting away from you. Part of why I liked buying an apartment was not the security of owning a place. It was like knowing that because there was the stamp duty exemption, I didn't really have to, pay a huge amount of taxes. And now I at least have an apartment. So if the property market for me goes to hell over the next 5 years, loosely, at least that just makes it easier to buy a house. And if the property market goes crazy and it's harder to buy a house, at least I myself I've hedged into the market a little bit, and I'm at least getting a bit of that kind of a value back, obviously much less because it's an apartment. They're probably like the two things I would say is like, if you want to live somewhere under the stamp duty exemption, you could consider buying a place just to de-stress the housing market increases and take advantage of first home buyer grants and stuff. But that's quite left of field. The main one is consider investing some of that cash into some safer ETFs.
And so when you say safer ETFs, do you mean ETFs that have, say, some bonds in them as well? So I think Vanguard has some options where it's maybe only 70% invested in shares and like 30% in bonds or something like that. Is that what you're getting at?
Yeah, exactly. I mean, to be honest, if I was in your kind of situation, just trying to imagine it, I would probably be more inclined to invested in the normal ETFs I invested in anyway. And if I'm perfectly honest with you, I probably hope to buy a house in 3 to 4 years too. Maybe not regionally. It kind of depends on how my finances go. Sydney's like the hope, and then if things don't go great, it's like, nah, we tried, and then it's like gotta leave this place. But the point is, I invest in ETFs that are like 7-year time horizons, and I'm like, okay, that's fine because there's good financial benefits. They have great growth. And you know what? If I get to around 3 years from now and I want to buy a home, and it turns out that, there's a war in the South China Sea and everything's dropped by 20%, then you know what? I'll probably just keep doing what I'm doing for another couple of years and like deal with it in the worst case, because like it's not like there's a time expiry that I need to buy a home at that exact time. So that's at least my strategy. I kind of am in those longer time horizon ETFs, then the time horizon I probably need to liquidate them. But I know that it's most likely going to be okay. And if something goes weird, I can just change my life plan around. And that helped a bit. And then my last kind of comment, and I just feel a bit of empathy for this question, is you talk about having $225,000 in cash. I had that much cash in the bank account before I bought my place. And I think towards the end, I forgot how much I was starting to pay in tax as well, because when I first started saving, I had like very low income. Whereas like you talk about, your household income is $250,000. I can't remember the tax rates off the top of my head, but you're essentially looking at 37 cents on the dollar is being taxed on the interest on those savings accounts. Whereas like the situation I'm in now where I've tried to buy more high growth ETFs, it's all kind of tax deferred and it's all CGT discounted at the end. So, there's that benefit compared to, the 3.2% I get on a savings account. Not that might be getting in the weeds a little bit, but that was also something that really dawned on me when I had that cash versus invest question for like a 3-4 year horizon.
That's an unusual take, I reckon, mate. I didn't expect that from you.
To invest it?
Yeah.
As opposed to keep it in cash for 3 or 4 years?
Yes. So I suppose I definitely see where you're coming from. There's a couple of different ways that I look at this situation. And to your point, it would definitely be more tax effective if they were to, and probably it has a higher likelihood of having better returns if they were to invest over the next 3 or 4 years. The only problem is that it might not, right? And it might, there could be a situation where houses regionally go up quite a bit in the next 3 or 4 years, and then that 200K they've got for the house deposit goal is not quite enough, and then they need more, and then they need to sell some shares to then get the house they want at a bad time to sell shares. That's a possibility. It's maybe not a likelihood, but it's a possibility. So it depends how you feel about that situation and how much that would stress you out, or whether it would bother you at all. Maybe it wouldn't. You'd just be happy to get your house, and if it didn't work out, at least you made what you thought was the highest probability decision at the time, which would be, I think that would be perfectly suitable.
Could I ask a question, Dave? Because it's really interesting. You talk about, this kind of stress of what if the house price kind of gets away from you. Would you say then that arguably the safest thing they could do is to go buy an investment property regionally and kind of lock themselves into that market, even though there's like a bit of a burden in the shorter term? At least they're not exposed to that kind of like price craziness over the medium term.
It's difficult, man, because I don't know how familiar they are with the place that they're moving to. So it's easy to just buy an investment property, but then when you actually get there, it might turn out to not be the ideal place that you want to live because you haven't actually lived there yet. I'm assuming they haven't lived there yet, then they're not just actually returning to a location that they're...
Yeah, if I could break that into 2 pieces. So you're saying like if they're really, really familiar with the area, that could be interesting because it's a lower risk decision.
Yes.
And if they're not familiar with the area, like say someone like me just in my head goes, oh, maybe I could move to Bathurst. And I've been to Bathurst like twice for a weekend. Then that's much scarier because you're really hedging a lot on a lot of assumptions there.
Yeah, that's how I would see it. And even then, I would prefer to rent in a new location rather than buy until you definitely know you want to stay in that location for a long time. So I probably wouldn't even approach it with the mindset of I'm going to buy a house as soon as I get there. I would approach it with the mindset of, okay, we're going to rent for 1 or 2 years, get used to this regional location, then pick exactly where we want to live and make sure we want to live here for a long time. And that's because of the large costs associated with transacting property if it turns out not to be the ideal decision. So you want to make sure that it is before you go into it and spend potentially a lot of money on it. But back to the other way that I was going to look at it. So I tend to think of two different extremes, right? Where you can build a bigger deposit. So that's one of the options where they keep saving up more and more cash, and no, it's not tax effective. It's going to be probably annoying. They're going to earn some interest, but they're going to lose a decent chunk of that interest to tax. But they could build a much bigger house deposit within the next 3 or 4 years. And the upside of that is there's certainty over being able to purchase the house. There is no uncertainty around investment returns because that money is going to be in high interest savings. And then also when they actually decide to purchase the house, they're going to have a much lower mortgage and therefore a much lower mortgage repayment and therefore a much lower need for them to work as much at that particular time, because one of the big motivator for them was to spend more time with their daughter when they move regionally and have a mortgage. So if they have a lower mortgage, that's going to be much easier to do, or it's going to be much less stressful or less onerous on them in terms of work needs. So I think that that's definitely worth considering, because if they've got 200 grand now and they're on pretty strong incomes, I mean, household incomes like 250, they're going to be able to save quite a lot. So they might end up with like a, I don't know, 400 grand house deposit or something like that. So even if house prices over there go to 800, 900, $1 million, they're still not going to end up with a massive mortgage. So they're going to be in a much better position to then have a cruisier life for their daughter's childhood if that's what they wanted to do. And then they can always, because it's not like they're locked into that decision forever. They can always then, if they spend the first 3-4 years spending time with their daughter and enjoying that with a lower cost lifestyle at that point, then they can always, the daughter goes off to school and then they go back to work maybe full time, and then they can always re-leverage up again if they want to then get more aggressive about building their wealth and then to retire sooner over the following 10 years or something like that. So they're not locked into choosing the safer option. They can always kind of readjust that later if they wanted to. So hopefully that makes sense. The other option is, of course, as you said, they invest more aggressively now, and then they can either sell some shares if the 200 grand turns out to not be quite enough for a house deposit, or they could just go with less than a 20% deposit and pay some LMI and keep their investments as is. So there's kind of two options where, one, you end up with lower debt and lower expenses and potentially more freedom or less work needs to have your kid time, which you might enjoy a lot. And then the other one is maximize investments, but then that's also going to come with higher ongoing expenses from having a higher mortgage. So that's the two different ways I look at it. Obviously there's a middle ground, but that's an easy way to kind of frame it in your mind and what's the most appealing. I hope that makes sense.
I think it makes sense. It's really interesting thinking about risk. I mean, I think all we've really talked about here is that the amount of cash you hold versus invest it really comes down to your risk appetite and how much you want to stress about stuff. One last kind of comment I'd make, and this is something I'd have to think of, I've thought about in the past a bunch, is you also have to ask yourself whether you're sensitive to having lost money in the market or whether you're sensitive to not having enough for the deposit, because I think they're two very different things for me. So some people, they're sensitive to just losing money in the market at all. Like even if their shares go down a bit and they sell them out and they have tons of money for the deposit and they can buy the house, they're just kind of sad that like they had to sell out while it was down 8% or something, right? And if you're kind of in that camp, then the heavy cash approach makes a lot of sense because you're sensitive to essentially poor timing of the market at all. If you're someone who like understands that, if you invest, then there's over the time horizon you've described, then there's a chance, granted a low chance, but still a chance that you make a loss on some investments, but you still have tens of thousands, maybe 100 or 2,000, plus you get to buy the house you want, then that's where it gets slightly interesting to do the investing as well. And as an example for you, let's say right now I think it'd be nice to buy a house in Sydney one day. Maybe I need a $500,000 deposit for it, and I'm not scared about market timing or making a loss. I just want to be able to buy that house when I want it. Then a way I could think about it is I look at, say, returns of investments historically. I say, well, assuming I just need the money in a 6-month period, it's reasonable to assume that if things go really bad, I might lose 30% of the investments. That's a pretty terrible outcome. Okay, well, I just need to invest as much that if I lose 30% of my investments, I still have my target amount. So as long as I'm investing, say, $800,000+ and I accept that there's some risk, I can always still buy my house. And that's someone who understands that they might lose the money. They just want to still be able to achieve their goal. And I think it's worth breaking up which of that kind of side you're on, because I've been both of those people at different times naturally. So that's worth considering.
So you'd focus mostly on investing in this particular case?
Yeah, because they have the ETFs already. I think that's like a big thing to point out. Like, let's take a scenario. They are looking for a $200,000 deposit, right? They say they've got 200,000 in cash and 100,000 in ETFs already. If they only had 200,000 in cash, I'd be like, don't invest all of it. Not only because you need some cash, but also because, like, what if the market craps its pants 30-40%? Now you're only going to have like 130,000. But like, let's say they invest a lot of that 200,000 in cash, and then it only turns into 130,000. And just for the listeners, that is like a disastrous, horrifically unlikely outcome, to be clear. It's like Armageddon level stuff. Even if it turns into 130,000, they've still got their other 110,000, which when you sum, even if that drops, when you sum it all together, you've still got your deposit amount. I always have this saying that's like, live my life like I'm statistically average, which is how I try and think through all of this stuff too. It's like, I try to plan for, in the worst case scenario, I'm still okay, but I'm not going to like plan around being successful in the 1% chance, because like we all just get unlucky sometimes in life. The point is that extra $100,000 in ETFs gives them a buffer, given that their goal is they've already like exceeded their goal. So they can add some risk to it, and it would be very different if they were talking about investing cash when they hadn't even got the liquidity value of their goal.
The only other thing I can think of in this scenario that's worth considering is it depends if they were planning to potentially debt recycle their mortgage later. Because if they were to pile up more cash for the next few years and then they buy a home, they could potentially debt recycle a good chunk of that mortgage and then have the benefits of both, essentially, where they'll not getting hurt by tax, and then they're going to have more investments later. But again, it's going to depend on whether they'd rather have lower expenses or they'd rather have more investments. I'm actually not sure which one I would choose in this scenario, because I could definitely see myself taking the aggressive option and investing as much as possible. But I also like the idea of minimizing expenses and having a lower mortgage. And with this time frame, I'd be hesitant to invest a lot of my money if I was definitely going to be wanting to use a big chunk of it for a home purchase in a few years. So I'm a bit torn, mate. I can see myself going both ways on this scenario.
That makes a lot of sense. Just another little kind of side note too. One of the nice things, if you have like this 3 or 4 year horizon, like generally you shouldn't invest in the standard ETFs people talk about unless you're trying to save for a long time, right? But also nothing stops you from buying these more ETFs. And then if it turns out that in 12 months, at least 12 months, 18 months, 24 months, the portfolio has just gone up 10%, nothing stops you from selling it out then and just keeping it in cash. And in a way that can be useful because, let's say you have a 4-year goal to own a home. Anytime after the next 12 months, if you feel like you've had a good outcome from it, you can just sell it out and turn it into cash anyway. So in a sense, you've actually got like a 2 or 3 year window where you're just hoping for like a good outcome where you can look back on it and be like, well, I invested and I got a return. And a 3-year window to feel like you made a good investment return is pretty good in most cases. And the only thing that you really are risking, in my view, and as someone who's invested a lot of money recently that used to be in cash, is quite frankly probably an absolutely significant geopolitical disaster or something like that drives us into the war. Like, I definitely look at the YouTube videos of, at the time of this recording, it's like just a few days after Israel and Iran have been playing with each other quite rudely. And I look at that and I think about Israel and Gaza and I think about it. And then I'm like, oh yeah, and then the Pakistan, India thing. And then I have lots of friends in like pseudo military jobs that are talking about what's gearing up at the moment in the South China Sea. And there's definitely a part of my brain that's like, oh, you know, is this about to be like a potentially very bad, 4 to 7 year period that we're on the cusp of? And that's the Dave argument there of like, it's just a lot nicer in cash, because you could argue that the last thing you want to think about is geopolitical disasters and tariffs and shortages in grocery stores and recessions. And then suddenly your portfolio is also going down whilst you have like a young daughter all at the same time.
Yeah, it's tough, isn't it? Because on one hand, you want to make decisions based on probabilities if you can. But then on the other hand, you also want to be in a situation where you've got enough savings and you're in a position where whatever happens, you're not going to panic and you're not going to freak out and you're not going to be detrimentally affected too badly by whatever kind of scenario you find yourself in. So it's a little bit tricky to balance those two things at the same time. But like you said, that's actually a good point where if you do choose to invest more of the money and then essentially just stick with the house deposit you've got and invest any surplus beyond that point, you could see it not so much in terms of committing to investing for that whole period, where if you get a really good 12 or 18 month period, there's nothing that says you can't actually then, okay, I tried my luck and it worked out, so let me cash out and then I'll put that money to the side, because you don't need to, stick with it religiously because that's the decision you chose. If you do happen to get lucky and sit through a very friendly market period over the next 1 or 2 years, you can definitely pull that money out. Yes, pay some tax, but then likely be further ahead. And not saying that that's what you should do, but if you find yourself in that position, I don't think there's anything wrong with doing that. That makes a lot of sense, because you can't then go backwards after you've already cashed out.
Yeah. And if you don't mind me asking, Dave, just on my previous point, we see some of the horrific stuff that goes on in the world at the moment. Does that ever scare you in terms of your portfolio, or do you ever get kind of worried about the short term or think, what if there's another COVID, or have you gotten to the point where you just drown that out and think, I can't predict the future, I'm just going to keep doing what I'm doing?
The second one. I just really don't put any stock into something that I either can't predict or can't control or can't realistically expect myself to be able to maneuver around. Because even if I get it right and think that something's coming soon and then that bad event does eventuate, I'm not going to know then when's the best time to get back in or something. You have to be right too many times to a level of detail that's just going to be like luck based. It's just going to be, and then imagine the mental anguish of then having your money sit out of the market because you expect something to happen and then that doesn't happen. The market continues going up. You're going to just destroy yourself inside. You're going to be so angry, and then you're going to be thinking, oh, the market's in a bubble soon, it's going to fall because XYZ, and then you'll wait longer and longer and longer, and you just get bitter because you've got more and more cash on the sidelines waiting for this market timing scenario to work out perfectly. Or if it does work out and it falls, you're going to wait for it to fall further and further and further, because as we know, when bad things happen, then the bad news starts to filter through, and you never get positive news stories when you're in a market downturn, even if it's at the bottom of the market downturn. And then even when it starts to recover, it's still endlessly relentless negative news and negative stories about why it's going to get so much worse just in a minute, just around the corner. All these risks are present. So it's something that's never going to go away, and you can't expect yourself to be able to navigate around it in a way where you can, outperform and avoid drawdowns. I just don't think that's a realistic way to go about your investing. So it's not something I really put any stock in. I just focus on what I can control, and that's just continuing to manage my money sensibly and invest whenever I can invest and make good decisions, and that's about it. I don't really worry too much about anything outside of that.
Oh, that's great. No, I appreciate you sharing that. And I think for our listener as well who asked the question, we hope everything goes well for you. Congrats again on your daughter and your plan. And I mean, just talking about this stuff and even the question I just asked Dave, I think it's a great reminder how lucky so many of us are, like Dave, myself, this listener, that we get to sit around kind of musing about how we're going to take some, good fortune and hard work we've got and turn it into an even better life. Particularly, I think, again, last week for me has been reading a lot of news from Air India crashing to all this Middle Eastern stuff. And yeah, it's just a really great thing seeing all these kind of positive stories and people with new families going and doing cool things. So hopefully many of our listeners are in a similar spot, and hopefully we've been helpful today for some other people who may be in similar situations, and things we've said have helped either give them a new perspective on what they might do, or perhaps even reaffirm things that they were considering doing and now really don't want to do after hearing some of these topics explored in more detail.
All right, I think we've got time for a quick question, mate. So I'll read this one out. I'm curious about how much in assets you need before it makes sense to create a self-managed super fund. I've heard that around $250,000 is the minimum.
That's a good question. I don't have an SMSF. I know lots of people with SMSFs. I think the simplest economics I could describe with SMSFs are like SMSFs. I mean, firstly, let's just unpack it. SMSF, self-managed super fund, it basically means that rather than getting a company to manage your retirement, savings like most Australians do, like myself, you simply kind of manage it yourself. And the managing it yourself really means that you pick your investments and you have a bit more flexibility and control there, though you essentially need an accountant to manage it. And that accountant costs money. And in particular, the costs for that are typically a lot more fixed in nature, as in they might cost, a couple grand to set up and then 1, 2, 3, 4 grand a year to maintain. Historically, why these I think were really interesting to people was once you had a certain amount of money, call it $500,000 to $1 million, just as a ballpark. Once you had a certain amount of money, the fixed cost of having that SMSF was simply lower than like a percentage cost that a super fund might be charging, right? I think there's a couple things to unpack there too. Number one is super funds in recent years have gotten better at being a bit more competitive with pricing. I'm only 32 now, and I don't want to pretend like I've paid attention to SMSFs for 20 years, but from what I've read and what I've studied about it, you're seeing super funds now that are doing like flat rate, $99 a year. That's their administration fee. And then they'll have some investment options with really, really low management fees and stuff like this. So if you like a super fund and it has investment options that you like, there's a lot of very compelling super options out there in industry that would make it very hard to justify the cost of an SMSF. SMSFs might be sometimes cheaper for people with lots of money, and where a super fund they're looking at simply doesn't have what they want at the prices that they want. The other area that you see SMSFs get a lot of attention in is when it comes to people wanting a great deal of control over their super. You'll see this comes up with people who say, I had a friend who they worked at, I think at Tesla. They obviously made a ton of money. And they were talking to me about how they set up a self-managed super fund because they wanted to put all their money into venture capital, into startup companies, because they were so inspired of how Tesla grew. They think that's where all their retirement should go, into like young Teslas, so they can make lots of money, right? That's really hard to do with a normal super fund because you've only got what's on the shelf. The other options people might use is those good old Aussies that really love bricks and mortar investments. They'll make an SMSF and just use it to basically get a whole bunch of investment properties. Sometimes people think that's a cool option, but without going too far into it, it can be less cool than it sounds, because you might think, oh, I'll buy an investment property in my SMSF and then I'll live in it, and then I'll get cheap rent and all like this kind of stuff, or whatever genius ideas people might have. But these things are really heavily regulated too. So like, with SMSFs, if you buy an investment property, I'm pretty sure you can't just rent it out to your uncle for $200 a week or something like that. It's very well regulated. Anyway, short story. If there's something really specific you want to do that your super fund can't do, or it so happens that you actually can't find a super fund that costs you less than a few $1,000s a year in fees, then it could be a really interesting option. I'd also like to point out, I'm probably not doing a great job here advertising for them, but I think Stake has a SMSF option. I haven't really seen much besides the ads that come up, but they seem to have tried to tap into this SMSF market by basically saying, if you invest through Stake, you basically use Stake's investment capabilities. We can do all the SMSF for you. We can manage it for like $1,000 a year. So they're essentially trying to compete against an accountant's, if you think about it like that. So they say your accountant might be $2,000 or $3,000, will be $1,000 a year, and much cheaper than that. That's the SMSF route. And then for completeness, I guess I can say this now because I probably just plugged Stake a bit. But and then when you look at a product like Pearl Super, which is like my company's super fund that we've launched, it's a different thing because we get a lot of customers who say to us, have you made an SMSF? And the answer is that like we made a super fund where you can just pick ETFs, basically invest in ETFs like a normal platform. It's just that we run it like a normal super fund, not like a self-managed thing. And the thesis with that is that it's typically going to be cheaper for a lot of people because whenever you have an SMSF, there's usually a high fixed cost. Even stake of $1,000 a year is still relatively high compared to what a lot of people will pay with some retail super funds, particularly if they only have, 50 grand, 100 grand. I don't know if that was a bit of a ramble, Dave, but I hope I covered a lot of the key points there.
No, I think that's a pretty good summary, man, because I suppose I haven't spent too much time digging into self-managed super funds, so I can't speak as much of an authority at all on this, but you're essentially setting up a trust and it needs a whole bunch of legal documents, and then you have to get it audited each year or prove that you're being compliant and all the rest of it. So yeah, again, it's going to be, maybe a couple grand to start up and then $1,000 or $2,000 a year ongoing. So if you've got a balance of 100 grand and you're spending $2,000 a year on it, it's like 2% per annum in fees. Like that's just not gonna be helpful for your retirement savings at all. You want it to be ideally under 1%. So if you're spending $2,000 a year or $1,500 a year, you kind of want a balance of 200 or more. So I do think that math that the listener has pointed out, I do think that makes sense. Under that, it's just not going to be worthwhile unless you expect to, outperform by several percent per annum somehow by controlling your own money, which is unlikely, I would say. I've got friends who do both, right? So I've got friends who, like you said, they like to own investment properties, so they'll have investment property in super, and you can borrow with your super to buy an investment property. You don't have to just have it all in cash. But when I had a look, the interest rates are actually more expensive, like 1 to 1.5% more per annum in terms of interest rate. So it's not cheap. It's to borrow there. It is, and I do think it is a lot more difficult as well to borrow there. So there's that. So it's not an easy thing to take lightly, I would say, because not only have you got the cost, because that's basically all we've spoken about, and yes, you get some more control, but there's also more complexity and more things to understand, and then you've also got the hassle of managing it yourself, right? You can't just, it's not hands off like a normal super fund where the money just goes in automatically. You pick your investment option and boom, you don't have to spend any time on it at all, almost ever again, which is very, very cool. So with a self-managed super fund, you're going to have to be on top of the investments, investing every month manually, or you can possibly even, I'm not sure if there's anyone that's got auto invest for a self-managed super fund, but that might be a possibility. But it's just a lot more hassle, I guess, and a lot more things to do. And it can definitely make sense at a certain point, but it's not something you want to just jump into unless you've got a good reason for doing so, I'd say. But the only thing that I find interesting and appealing once you are at that balance is that the self-managed super fund gets taxed individually as opposed to when you're in a normal, this is probably a topic for another day that we could unpack, Hayden, but when you're in a normal super fund, the fund itself, whatever option you're in, it gets taxed at the fund level. So essentially the super funds will harvest little bits of your capital gains within the fund on an ongoing basis to cover against future taxes that might be owing depending on the transactions that have happened within the fund. So essentially what happens is about 10 to 15% of the capital gains get harvested away for future tax liabilities within the fund. And so that's accounted for in the unit price. So you don't really see it. But the only way you can really notice it is if you look at, say, the indexed shares return. So if you look at like international shares or something with one of the super funds that do the index options and then compare that to Vanguard Index Fund, you'll notice that it might be like almost 1% per annum lower performance. And that's the reason, is that they're harvesting tax away for future liabilities. And so this is something that's become more well known about in the last 5 years or so, I would say. And so that's one thing that I find more appealing about being in an option where you can potentially have your super fund or have your super account taxed individually, where you're not being penalized. You can just buy and hold ETFs, or you can buy and hold whatever you want in there, and you're not going to pay capital gains tax be harvested away on a regular basis just because of that's how the fund works. So I do like that option for sure.
That all makes sense. I think for listeners who might be considering an SMSF, all I'd probably say in summary is I think there's a lot of focus when people talk about SMSFs around cost and fees and a way to try and pay less fees. And while sometimes the mathematics might be there, it's such a wildly different product with wildly different requirements and things like this that the main reason SMSFs should intrigue an everyday person who isn't rich, for lack of, it's a very qualitative term, but if you don't sit around being like, I'm rich, if you're not in that camp, then you're like, and your friends are like, they're rich. But if you're not in that camp, then an SMSF should be mostly intriguing because of the type of investing you want to do. That's where it really shines, because you can invest in a whole bunch of stuff and not just what your super fund says.
Just to add on to that, it depends what you're trying to do. Because if you just want to be in a situation where you want to invest in specific shares or very specific ETFs, and you want an exact control over how much you have in different investments and all that, you can do that with a lot of the member direct options. I think most of them are called member direct options now that a lot of the big super funds roll out, where you'll pay more fees. And I can't remember how much exactly, but it might be like an extra 0.5% per annum, say, or like the equivalent of a few $100s plus brokerage costs. But then you can then pick your own shares and have whatever ETFs you want. And there is some limits on like a maximum percentage you're allowed in each ETF, depending on how risky it's perceived to be. But that does give you some, a much greater level of control without going to the level of setting up a SMSF with all the compliance and costs that come with that. So that's probably worth considering if you just wanted a bit more flexibility and control, but not so much of the administrative burden and, fees that come along with that.
For sure. So if you are considering an SMSF, shop around super funds first. You'll be surprised how much you might find what you're interested in. I think as well, Dave, just my last comment here would be that what we're seeing in this space is what we see in much of finance, which is that there's becoming cheaper, more accessible ways to do everything these days, like whether it's investing, superannuation, banking. So, SMSFs, I'd say, proportionally over time are probably becoming less interesting for the average person with a $500,000 balance, just because tech improves all the time. I see this in retail investing and stuff like this. People be like, 20 years ago, people needed a stockbroker to be able to do stuff, whereas then a whole bunch of technology just came along and laws got changed or whatever it is. So always be conscious of that when you get advice from people too, particularly older people. This isn't to say that older people don't know what they're talking about or anything like that. It's just the landscape surprisingly changes pretty quickly with stuff. It's the same way, like, I tell friends to, download translated languages on their phone when they travel in case they don't have internet. And then my friends are just like, oh, I have this new SIM where I can travel to any country for $40 a month and I always have data. And I'm like, oh, okay. I didn't realize you could just do that now. I guess technology is just constantly figuring some stuff out. So it's a good kind of thing to have whenever, technology just improves over time. But anyway, that's a bit of a...
It's actually a really cool time to be... I think we're probably extremely lucky to live in such a time where it's so easy to be an investor, especially where markets are concerned and everything's online and simple and accessible and very, very cheap. And there's so many features and, functionalities and options that we have now. In some ways, it makes it more difficult for people because there's so many options, but it is really powerful and really, really cool to see the way things change, I'd say, for the better for the average investor over time. So it is cool that it's heading in that sort of direction.
100%. So I think just to wrap up today, obviously we've had 3 really interesting questions. It was really great to talk about one of our listeners who's in their mid-40s trying to figure out how they can retire sooner if they're ready to retire, and give us some advice about various assumptions and various things they may be able to do. We also heard from a lovely couple in their early 30s in Sydney looking to move regionally, and some of the progress they'd made and how to decide how much cash they should save and how much of it should be invested, and some of the pros and cons around different things we could do there. And we had our last question on SMSFs, which really opens up some topics we're going to cover in the next few podcasts around superannuation, tax drag, and a whole bunch of other interesting things. So keep an eye out for that if you're interested to learn more about superannuation, different types of superannuation funds, and everything else around that area. If you've got a case study you'd like us to have a look at, there's a link in the show notes that you're able to go and follow to submit your case study. If you summarize it neatly, we are more likely to pick yours. And also, we'd love to hear any information you might not think is relevant. If you've listened to our podcast before, you know that we always have to make assumptions about what's going on with the house, what city do they live in, and it just makes it easier for us to give really interesting perspectives if we know more about what's going on. Also, for any listeners who filled in the form in our show notes and they filled it in prior to the 17th of June, if you've expressed interest in coming on the pod or sharing your story personally, even without using your name or any video like that, we'd love for you to reach out to us via email, because for those people who express that interest, we didn't actually capture your email, so we don't have a way to contact you. So if you're one of those 20 people, feel free to email us at aussiefirepod@gmail.com and we'll be sure to reach out. If you don't have a case study, but you just have a question you'd like us to tackle, then you can send it in to hello@aussiefirepod.com. You can also reach out to Dave and I on socials. Dave with the Strong Money Australia, beautiful brand that he's built, and myself with Perla. Just look up Perla on any socials, you'll be able to reach out. Otherwise, we love hearing from your stories. It's some of our favorite episodes, and we hope this has been insightful one way or another. Thanks for listening.
Thanks, guys. Catch you next time.
We hope you enjoyed this episode of Aussie Fire. For more FI inspiration, head to perla.com to browse our resources, calculators, and community insights. Perla is an authorised representative, number 1281540 of Sandland Private Wealth Pty Ltd with AFSL number 337927. Knowledge is power, especially when investing. So always seek advice and/or check out the relevant disclosure document for any financial product, including the PDS and TMD before deciding. These are available from the product issuer's website. When you invest, your capital is at risk, and past performance is not a reliable indicator of future investment returns.